Broadcast is now starting. All attendees are in listen-only mode.
Okay. I think I need to welcome members and guests. This is Joanne Obata, President of the Virtual Investment Club of Sacramento. We are a Better Investing Model Club open to the public. All of our meetings are, oh wait, did it say in listening mode?
Yes, it did.
Okay.
Yes.
All right. I just want to make sure all of our meetings and stock studies are virtual, and we are honored to have members who are from around the world in the U.S., including Canada and China. Guests, you will be muted during the meeting as observers and will have an opportunity for questions and comments once the meeting ends. We have a disclaimer. The stocks presented today are for educational purposes only and are not intended to be a recommendation for buying or selling any stocks. We ask that you conduct your own review and analysis of any company of interest before making an investment decision. The views expressed are those of members and do not necessarily represent those of Better Investing. This meeting is also being recorded for future use and will be posted to our YouTube channel. Okay, so now, let's see, I am going to, John, are you on?
Yeah, can you hear me?
Yes. Okay. So John will be giving us an educational topic on, let's see, average PE is not really an average PE. So I am going to be switching the presentation over to John.
Okay.
Okay, hold on. So you'll see an accept. You should see a.
Okay. All right. I had to use like a slide presentation. I can make the whole thing really big. It might be easier to see. So let me know if I'm going to try that first. So let me know if everybody can see it when I do this.
Okay.
There we go. Okay. All right. It should be coming up in a second. If not, can you see that well?
Yeah, I can see it, John. This is Bernard.
Okay, good. Great.
Yep.
So I'll go ahead. This is more just like a, I don't know if it's educational, but it's something that over 20 years ago bothered me. And I came to, I think, what is a solution to what confused me all these years. And so I just wanted to share it. So basically what I'm going to talk about today is average PE. That's the same thing that we see when it says high PE, low PE. It says average PE. And what I've seemed to have sensed, and maybe I'm wrong, is that in this specific group, it doesn't seem to be the sort of big deal thing that it was in other groups I was in. So I just wanted to talk about it. So anyway, shouldn't the average PE, if it's average, it should happen at least occasionally, right? Isn't that what average means? So that's what I want to discuss. So next slide. All right. So why do I care about the average PE? Well, let me tell you my history, and some of you may have the same experience, some not, but I'm just going to give it to you anyway. My first SSG class a long time ago was by Bob Adams in Puget Sound. And he said just about, I can remember this day, that buying a stock at or below the average PE would keep me safe from significant losses. This same statement I heard echoed over and over again over time. And after going through some pretty bad markets, the dot-com crash and the recession, the big recession, I realized that I broke that rule occasionally and wished I hadn't. So this rule has been validated to me over and over with time. The club I was in at that time, which in Puget Sound was called the Matrix Investment Club, had over 60 members, had $250,000 in assets and a 30% annualized return. Remember, this was around the dot-com. Everybody was doing quite well. They said to me, we never buy above the average PE. Never. And they really made that stick in my mind. That's why I held it all these years. They also, when they figured out the price earnings ratio, they wouldn't use the last trailing 4 quarters. They'd actually go back to the whole year before. I hope that's not confusing, but basically what we usually do is take the price and look at earnings in the most recent 4 quarters. Well, they would just use annual. So by the end of the year, it would be difficult to buy stocks because we'd be using a price that went up and the earnings would stay low. So that even kept us safer, if that makes sense to you. So anyway, I went in and decided to try to find out if anybody else thought this. So I perused some of the education on the website, and sure enough, I found at least 2 references The quotation basically that I heard in Ticker Talk in September 2017 was something I learned from one of my very first meetings in the Puget Sound lectures. This is not me, this is somebody else saying it. If you never pay more for a company than average PE, then you probably will never go wrong. And he also said we look at many things in terms of valuation, and this is one thing I've never forgotten. This was Chris Kersop, who's the president of the Puget Sound Better Investing right now. And that was in Ticker Talk that I've listed right there in September 2020. I found another reference, at least verbal reference, stocks up February, it must be February 3rd, 2016. Hidden Dimensions of PE Ratio, John Rogers, who I can't remember his credentials, but he's got a PhD in physics or something, very smart guy. He said, he's the director of Rocky Mountain chapter. He said similarly that buying stocks are below the average PE is a good rule to follow. I actually emailed Ann Cunez because I thought I'd heard her say it in the past, and she didn't have a reference for me, but she said that maybe they're going to have a future Ticker Talk specifically on average PE, so I kind of look forward to that. The reason this came up to me about average PE is that in the old, at least as far as my memory recalls, in one of the toolkit versions in the past, you could actually see all the earnings for quarter per quarter, and then you could see the last 4 quarters of PEs. And I would look, because my club was so strict on average PEs, and I found that sometimes 5 years, it would never occur as the average PE. So I was quite confused. I asked that question once in this big class, and no one answered me. So all these years, I've wondered and finally decided to do something about it. Also, I think there's a misspelling in number 6, but you don't really realize, APE means average PE. You don't realize that buying at the average PE is usually a prudent idea in bull markets because everybody's doing so well. But when a bear market comes, when you look back, you start to reinforce that rule. At least that's been my experience. So let me go to the next slide. Now this slide is extremely busy, but I'm going to try to make it less busy by eliminating part of it that you can look at later and just focus on what's really happening in the slide. I made up a company that grows at 30% compounded annual rate of return. So here's the earnings, quarterly earnings right here, and I avoided this year because I don't have enough historical data back to this year. And so these are the earnings, and you can see that this 40, here's the 30% growth, 30% growth. So I made up these numbers, this 30% growth, and I basically just made the quarterly earnings all add up. So I synthesized this whole process, but this is what you would see for a stock that grows at 30% annually. The prices I made up also, but I made the price follow basically the same increase in earnings. Here's the prices to basically give, this is the PE, the trailing 4 quarters PE right here is 20, 20, 20, 20. So the bottom line is this. I decided to make up a stock that grew at 30% and see if the average PE would occur if that stock grew pretty much the same rate as the earnings grew. And what I found is this is the PE. So I go over here, and here's the low PE. I just used this definition down here that we all use, the same thing. And I have all the low PEs. I have all the high PEs for trailing 4 quarters. And then I come over to this side, and I look for the average PE. Well, the average PE is simply the low PE plus the high PE divided by 2. And as you can see, because it's a steady growth stock with steady earnings and steady price, that the average PE pretty much remains the same. So does the high PE, so does the low PE. But guess what? The average PE never occurs in this 2-year period. And if I extended these numbers on for 6 more years with steady growth, you would never get the average PE. So I proved to myself without using Toolkit that we can see stocks that grow commensurate with their earnings in terms of price at the same rate, that the average PE will never happen. And we may never be able to buy that stock if the average PE doesn't come up and we use that rule. So how do you get around that? Now, let me tell you, first of all, that this stock that I invented here on the page that grows at 30%, and again, this is the steady earnings, the steady price increase that's pretty much equal to the rate increase of earnings, that it doesn't usually happen this way, that I have waited many years sometimes to find the average PE, and I have done a note down here that I waited 8 years for Home Depot to have an average PE, and I bought it at that point. So the point is that you're mainly using the average PE to keep you safe, to wait for a pullback in the stock, because that only becomes evident when things go wrong. If things are going well for 20 years, you might wish you bought it, but it's just a safeguard, and one I think that makes sense. So basically what I just mentioned here, that we have a high growth company. If you look at this, this should be would have almost doubled in 2.5 years, and we never bought it due to high real-time PEs, never reaching an average PE. Now, why doesn't the average PE ever happen? Well, it's because I finally figured out that average PE is not an average. It really isn't an average PE for the stock. What it is, it's the high and the low one put together. But the problem we have when we look at the PEs, and maybe everybody's realized this but me, and I'm wasting your time, but that we're using a price of today, but we're actually using earnings that happened in the past. So we're not using real-time prices with real-time earnings. Our earnings are always in the past, and people are going to anticipate the growth of those earnings, and so the price will go up before the earnings go up, and that's why we actually can't get the average. So average is not really average PE. It's this definition right here, the high and the low divided by 2, but it doesn't mean that that PE happens an average amount of times, because it may never occur. So basically, it's a fault with me thinking that the average definition really was average, and it's not. It just means this. Anybody follow me at this point?
I do, but I've got some questions when you're through.
Okay, I'll be done soon. So basically, I'm sorry, I'll go ahead. So anyway, I made up this stock, and basically I wrote down here, we're using year-old price values to determine a ratio with a 3-month-old real-time earnings. That's confusing, but basically we're always behind in the earnings, but the price may go ahead of the earnings because we can't know what the earnings are second by second. We're always at least 3 months old when we use the earnings, and then we're using 3 quarters before that. It would seem by definition the term average should happen averagely, but it actually never happens in real time, especially with a high growth stock, because high growth stocks tend to go up much more, what's the word, at a higher angle, and their deviations high and low won't really bring it into the average range. A stock that grows at a lower rate, if it has deviations, may tend to bring it into the average range. So what do we do about this? Do we always buy at the average PE? Well, this stock, if it grew for 20 years, we would have lost a lot of money. So how can we resolve this, at least in our minds, and say that we're breaking the rule, but how much do we want to break the rule? So you can use 1 to 3 quarters of projected earnings to bring down the real-time PE, the PE that you're looking at. So over here, what I did was I added a quarter of earnings to each one. And by the time you add 2 quarters of earnings, you get below the average PE, or actually 1 quarter, you get to 19. So you can project a little bit out into the future to bring down what your average PE would be in the next quarter, assuming that you knew what was going to happen then. So that's why some people say, you know, the PE on next year's earnings, the PE on today's earnings with 1 quarter added or 2 quarters, because they're very motivated by the stock. So I put down here, how can we buy a high growth company with regard to PE that doesn't stumble? Now, a lot of these companies are going to stumble over 5 or 7 years, almost all of them. But if you want to buy it, and I want to justify to myself why I did that, looking in the rearview mirror, I can say, well, I used 1 to 3 quarters projected earnings. I really believe in this company. Also, if you look at big charts, and in one of these discussion groups, he shows how to go into big charts. Maybe everybody's done this, and show the rolling PE and the average and the highs and lows PEs. And you actually see sometimes it may take 8 years for a stock to really be in the average range because of some mishap with the company or some downturn because of whatever process. So we would look for turmoil that can bring it down to the average PE. And again, I waited 8 years for Home Depot, and maybe I would have done fine if I bought it 8 years before, but I felt good when I bought it, and it did well. Also, there are many companies, one may happen to fall in the average PE range. So if you're looking, that's why it's a good idea. I mean, I tracked Home Depot for 8 years. Otherwise, I wouldn't known it was in the average PE. And I actually waited. I bought Cognizant recently because it had a 20% drop in one day, which brought it down into the average PE range. And I was very happy that I'd made a 60% return in 2 years. And I actually emailed Cabuto because he'd had it for 13 years and he had a 4,000% return. So what I asked him is how he had the stamina to hold on. Because if you look at the price chart for Cognizant, it goes all over the place. And there's many cases in which you would have thought, well, I've lost all my earnings, all my money and want to get out. And he basically, this is what he said to me, and I was very impressed. It was so simple. He said he just looked at the quality of the company on the second SSG page, and as long as those financial numbers look good, it gave him the strength to hold on to end up with a 4,000% 13-year return on Cognizant Technology. That's it.
Tom, do you use forward PE?
John.
I'm sorry,
Yeah,
John.
that's right.
Do you use forward PE? Because a lot of companies, like you go to Yahoo Finance, they will have future and forward PE routinely listed for companies. Does that help any?
I don't really go in and see. I actually add the next earning. I do it manually in my brain. I don't look at Yahoo. I mean, they're probably going to get the same number, but again, I try not to buy over the average PE. That's what I've done the whole time, and many times, you're going to be okay most of the time, but when a crash comes, you're going to crash. The stock's going to go down a lot more than it would. So basically, you're just looking for a discount. But I will actually look and see what the analysts say for the next quarter, and I'll add 1 or 2 quarters. And I don't feel too uncomfortable with a high growth stock that I really have a lot of confidence in, adding 1 or 2 quarters. But when you start adding 1 or 2, 3 years, that's when I think I just can't do that. I don't feel safe doing that.
John, this is Roy. I have a couple comments and questions.
Sure.
I agree with your main thesis about, don't buy above the average PE. The page we're looking at now, I wish you had used a real company and their numbers, because I would have more faith in what you were saying.
Yeah. Well, I could use a real company, but I'd have to look at many of them, and eventually they may turn into.
Well, no, just for an example, like I could pull up Apple and do a chart like that.
That's why I said.
That's it. So,
right.
But okay, so the SSG only gives us the high and low for the year each year, right? And they take that average of those of the average high and the average low is the average PE.
Yeah, and that number.
To figure it on these quarters, you have to do it manually, or
no.
is there a program that you can run where this automatically does it?
Oh, you could have one that if you're smart enough. But I just figured out what would be 30% return, and then I basically made the earnings go up a little bit each time. Again, you could have used the math program, but just not smart enough. But I wanted to see if I just made this go up each time, see the PE stays exactly the same the whole time.
Well, in your figure, but like I said, I'd like to see a real company.
Yeah,
but
that's
so if you took,
let me just interject before you go on, because I tried to get this before. If you go to big charts, you can put in a 10-year average, and you can see that sometimes the average, you can figure out the average PEs, look at the PEs over 10 years, and on many companies you'll see they only occur once every 5 or 6 years. So that was my point on that.
Well, okay.
I just want to say that we have a minute.
Okay.
Okay.
That would have been better with a real company, but I didn't want to make this into a big thing in the beginning. But yeah, that would have been better. You're absolutely right.
So, John, can you send this to me so I can post it in our drive?
I don't know how to send a slide presentation.
Okay.
but it'll be on the recording. I'll try to figure it out. If I can, I certainly will send it to you. I think, do you have Apple?
Yes.
Okay, good. I think I can probably send it to you. I'll certainly try afterwards.
Okay. All right.
John, is there time for one question?
Okay.
So if you, your earnings in any particular year don't change, but so you have the trailing or the quarterly earnings, which are constant, I guess, in your example here, but the stock price is going to fluctuate quite a bit within the year. And so if you keep the earnings the same, because they're released quarterly, and the stock price happens to be low enough, you will have a case where the PE is less than the average. Exactly.
But what I'm trying to tell you is, that's why I put in the example with Home Depot for 8 years. Some of these companies that are popular don't tend to get a low price. But again, if you're watching them, what I've been amazed about in the past is I think, oh, it'll never go that low. And next thing you know, 3 months later, it pops down. So yeah, I'm just saying that it could take 8 years, but it may take 1 week. So it's important to companies you like, if you want to buy them cheap, to watch them and see if it goes into that range.
Yeah, no, I was just commenting on the math because I kind of agree with what Roy was saying. Like if if you were to take the earnings and then for any particular company and then take the stock price on a daily basis over the same period of a year, at some point during that period, you might have, it's very likely that you will have a PE ratio, which is whatever the current price is on that given day divided by the trailing earnings will be lower than the average.
That's what I'm trying to tell you is you may have to wait 8 years, but you may wait 1 week.
I guess it depends. Like if you look at, say, Netflix, you may have to wait 8 years. but Apple has been fluctuating quite a bit.
Absolutely. Actually, you can look. I did Apple in big charts, and it showed periods you had to wait 3 or 4 years to get an average PE. So you can just experiment with those. But okay, great.
Can we move forward because we're already late?
Yeah, I'm done. Thank you.
Okay, Hanny, I'm turning it over to you.
Okay. I don't have a presentation or a lot. Nothing to show really, Joanne. So you can just.
But I thought you were doing the presentation for the industry.
Oh, okay. Sorry. I thought you wanted me to talk about. Okay. Let me just pull that up. Where is it here? Apologies. I thought we were going to talk about Tencent.
We're going to do the stock study first, and then we'll do Tencent.
Okay. Sorry.
That's okay.
Okay, here it is. And let me just, oops, no, that's not it. Do you have it, Joanne, or?
Yeah, let me look for it.
Oh, here it is. Okay.
Oh, you got it?
Okay, yeah, I got it. Thanks. Sorry about that. Let me, can you see my screen?
Yes, we can see your screen.
Okay, so this month we're doing cable and pay TV industry. So Joanne is going to do Disney, and Mina's going to look at Comcast. So I'm just doing a quick overview of the industry, some trends that are I thought would be interesting. So this industry has an SIC code of 4841. And NAICS code of 515-2010. That's important because everyone has a different definition. So if you look at the cable industry revenue these are the cable that comes to your home in the United States over the last from 1980 to 2016, you can see that the revenues were growing at a compound annual return of about 12.6% per year. Starting in 2013, revenues started to fall, and they're falling at a rate of -6%, 6.5% compounded. So the there's been a fundamental shift in the way that people are consuming media, and a lot of we hear a lot about cord cutting, and the numbers here are showing are validating that. This is just looking at the growth of various components of the media sector, and you can see that online video, so YouTube and other video content, online advertising, and video gaming are growing. Those are the only sectors that are growing. The rest are all declining: newspapers, books, magazines, and so on and so forth. So another sort of confirming the same trend. Now, digital video is growing, but it's not going to take over from TV just yet, and that has a lot to do with demographics, millennials, baby boomers, and how each demographic consumes media. So you could see on the left-hand side, this is the minutes of television watched, starting in 2016 and forecasted to 2020. It's going down. The red numbers are the percent change from 1 year to the next. So 245 to 238 between 2016 and 2017. That's roughly 2.86% drop. So you could see that it slows down. And digital video on the right-hand side is increasing, but the rate of change of that increase is also slowing down. So it's not happening as fast as as one might think. So this is just some sort of trends that I was able to identify. By 2020, Cisco says that 82% of all internet traffic will be digital video. There'll be a lot of VR headsets that are shipped, and that number is going to go up to 2.26 million from about 100,000. I didn't really think that this was, I thought it was a bit of a fad, and until I walked into work one day and somebody was showing me a nuclear power plant that we were working on, and they had done a 3D rendering of the inside of a reactor, and we put on a VR headset, and you could walk around and see quite a bit of detail. So it's not just in video gaming, but it's being used in a lot of other industries. If you're buying a new home, some of the home builders are now, if the home isn't constructed, they have VR renderings of these things, and it's being used in a lot of different areas. Another big trend is sports marketing, and a lot of people are starting to consume sports through online video, and I think they're Joanne and Mina might talk about this in their reviews. The potential acquisition by either Disney or Comcast of Fox Sports, which is a big thing right now because the World Cup soccer is on, and Fox has a big portion of that revenue. By 2021, there'll be 650 million subscribers to online services like Netflix and Amazon and Google. And 5G is expected to perform a lot faster than 4G, and a lot of companies are now moving to 5G. So all of these things are supporting this consumption of media through online video and internet. So you'll see less and less reliance on basic cable. Again, this is the first time in decades that cable television is not the majority. A lot of the millennials are age 18 to 35, and quite a number of those are not watching television. They're streaming their media content. This is just another slide that says the same thing. So you could see the various services, Netflix, cable, Hulu, and so on. And 61% of millennials are getting their online video through the services like Netflix, whereas non-millennials, baby boomers, are still using cable. So cable is not going to go away anytime soon, but it's cable companies will have to adjust if they want to maintain market share or compete with companies like Netflix. And this is again, you can see the hours of TV watched, and this is again aged 18 to 24. And in 2011, it was up on the left, it was fairly high, and then it's dropping down. At the same time, Netflix stock price has been going up, and you can draw some pretty obvious conclusions from that.
Question?
Yes,
can I ask a question?
sure.
I think I understand, but the difference between TV and digital is what exactly? Because I use a cable to get my digital content. So what is the actual, when you're comparing the two, maybe you said in the first slide I missed it, but the categories, how do you separate them?
So basically when you get your TV through cable, you're going through network television. Your cable company might also provide internet services, and you're streaming video through the internet. So things like Netflix, which is streaming through the internet, not so much through cable television.
And
Does that make sense?
Google TV would be streaming. Google TV.
Yeah. Yes.
Okay. Thank you. I got it. Thank you.
This is just, again, advertisers will follow where the viewers are, and so you can see here, this is the market share of different types of advertising, and television is at 35% right now, market share, and it was 38, so it's gone down by 3%. And then look at market share of digital, 17% in 2009 and 38.9 in 2019 forecast. So it's grown quite a bit in that period, but it's also overtaken television. And then traditional media like newspaper is dropping significantly. So going from 22 to 10% in 2019. So again, that's pointing to the fact that advertisers are going to go where the consumers are, and if people are consuming more media through digital, that's where the bulk of the advertising dollars will be going forward. And that's it. So any questions?
Yeah, well, I have two that seems like that sometimes to get streaming or something, you're still going to have to work with a cable company. I mean,
Yes, that's true. So, but I think so you'll pay for cable, but they won't be able to get a lot of advertising revenue through that. Whereas before, I think there was there's money through television. A lot of the cable companies own some of the major television networks. So you're absolutely correct, but I think it just depends on where the money is going for advertising.
Another question I have on advertising, for myself, I know I use my DVR all the time, and I usually skip through most commercials. Is that television advertising seems to me to be not very effective because people can buy it.
Yeah, and you can, if you look at YouTube, for example, now you're seeing these commercials come up on some of the YouTube video, and it'll say, you'll see the content once this commercial is finished, or they'll make you watch the first 4 or 5 seconds before you can skip through. So that's another way that they're getting around that issue using digital.
YouTube TV.
Report. Thank you, Haney. Thank you.
Yeah, I just want to say YouTube TV, which
I have
is
a question.
Yeah, sorry.
Oh,
Hello.
I have a question. How does net neutrality affect this industry? In what way?
I didn't really look at that, Jay. I didn't spend a lot of time on, but that's a good question. That might be something worth looking at.
I think generally it's a positive.
Right, that was kind of my concern about net neutrality. Yes, Matt, what did you say?
I think it's generally a positive for the companies because they can charge different amounts to different people.
So it's a positive for that industry, negative for consumers.
Yes.
I think it's also probably more favorable for traditional cable companies than it would be for companies like Netflix or other streaming services. The premium that they would have to pay for the bandwidth would also make it more difficult for new competitors to come on the scene as well, no?
Yeah, I mean, it may be harder for
Has
Netflix,
the law passed?
definitely for the consumer, it's worse.
Has the law passed on net neutrality? Because I really have not really thought.
Yeah,
was the law already passed? Okay.
Yeah.
So
I don't think
in
there
the
was a
future-
law, Jay. I could be wrong, but I don't think it was a law either way. The Obama administration put it in, and the Trump withdrew it. It was both of them were executive action.
Yeah, it's an FCC rule.
Yeah.
There was no law that was passed by Congress.
Okay, was on the law. Okay. Okay.
Okay, Mina, are you ready to present? Did you need?
Yeah. Sorry?
Do you want me to give you the screen?
No, I don't really have anything. I think it might just be
Okay.
useful to
All
pull
right,
up the
so
SSG, I guess.
Hold on a second.
Just a chart might be useful, but
So, do you want me to bring up your SSG? Do you want to just speak to the SSG, or do you want
yeah, I
to?
think that's probably a good place to start, and then we can talk
Okay.
about the future of the company, I guess.
Okay,
Thank you.
hold on a second. You're going. I'm switching the screen to you, and you're going to accept it. Hold on.
Yeah, I don't know actually how to.
Yeah, I'm going to make you presenter.
Okay.
Oh, actually, I'm sorry. I'm going to
Yep.
be the presenter. I apologize. I'm the presenter, and then I'll bring up your SSG.
Okay, so I will reject the.
So I'll take it back.
Okay, I've canceled.
Sorry.
I've not accepted. No.
Okay, there you go.
Perfect. Thank you. Yeah, so we've decided as a group, Joanne and Hanny and I, to look at the telecommunications industry. It seems like so. Comcast, as probably most of you in the States are familiar with, is the largest cable provider and owner of parent company for NBC, as well as with their Xfinity internet is where they provide streaming and internet services. As you'll see in the chart, it's a company that's presented with pretty steady growth of 5 years previous to today, but notably the earnings per share jumped significantly in 2017, which I mean, honestly probably threw off my calculations a little bit, or my projections. The reason for that, the closest I've been able to determine in the research, is that they saw a massive surge in subscriptions in streaming services and pay-per-view programming, and as well as there were apparently a hike in price points for pay-per-view services and specialty channels, as well as boxing revenue seems to have been a significant contributor there as well. So I guess the profitability of that is there's no real new cost to them associated with it. So this company has projected, it had 24% growth in 2017. The way that most of their new growth has come in the internet division. So Xfinity, they've opened up and will have access in 2018 to new markets, LA and New York most notably. So they'll be able to provide services there, as well as both financial. So for Xfinity, they can provide in the financial and commercial brands, it seems like that's where they're targeting the most part. So Wall Street is really where they want to have their X1 interface, I think it's what it's called, implemented in a lot of those firms. So I wonder, maybe that's something to keep an eye on in terms of their growth. A lot of projections had their sales growth much higher than I've put into the SSG. I mean, we plugged in 5%, which was along value line projections. I found previous to that about an estimate about sources like Yahoo Finance, NASDAQ, Morningstar, places like that. The BI sentiment had it about 12%. Most of that growth, I think, is being optimistic about the purchase of 20th Century Fox and Sky News. So, especially in light of their new bid. So I think that's where a lot of the projections came from, and I mean, their steady growth. But we've put in 5 for the value to be consistent with value line and to be conservative in our projections. The earnings per share, I think that's also where I had some difficulty. I found different ways online how to calculate it. One method involved taking the average or the latest latest EPS divided by the 5-year previous EPS and putting that to the power of 1/5. And that generated earnings per share projection for the next 5 years about almost 30%. So I mean, that seemed more than optimistic for me. So that's something we kind of just rejected, and in line therefore we kind of just relied on value line as well. If we're going to go with their growth, might as well go with kind of a consistent projection for earnings. It's funny that it's pretty topical that we were talking about average PEs today. Given that the PEs, you'll see the numbers on the SSG. If you look at the second page on it, I find it quite interesting. If we look at the historical high PEs and the low PEs, if in 2017 there's a massive drop. So we go from 20 on high to 9 in 2017, and from 15 or 14.5 to 7. So made it a little bit difficult to project where we see that going. I mean, is it going to go closer to a 5-year historical around 20 for a high, or is it going to stay, or is it going to hover around the 9 or regress somewhere to the middle? Seeing as I don't know, I've kind of picked the more middle number as 14, being that it's going to be lower than it was historically given this new surge in their streaming services, but it's not going to stay that low. Same thing for the low PE at 7. I think that was low. I projected 8. I think it gives us a good range there for maybe some variance, but I leave that to the group to tell me if I'm way off base. And then finally, for the low price, I think there was some discussion on the email thread about how people like to pick it, but I thought just for simplicity's sake, I took 75% of the current price on the date that I did the study. Gave me a low price of 24, and this price currently is at 31.5, I believe, or it might be $32 now. So it gives us a little bit of variance. Value line projects the range of high price to be between 75 and 55 for the same period that we're looking at. So there's a lot of room for growth, it seems like. I read an article today that, however, their latest bid for 20th Century Fox is 19% of a premium over Disney's last confirmed bid, and that would make them one of the most indebted companies there are. So it seems like it'll take them about $65 billion in debt in order to make that purchase if the current bid is to be successful. But I saw a more recent article saying that Disney does plan on providing a more competitive bid. So I think that's going to be significant in determining whether we're comfortable investing in a company with such a high debt. And we'll see if Fox, with the streaming services, how much can they make value of the movie studios that they might purchase. But in any event, the ratio, the upside down ratio that came out from this calculation was 5.9 for 1. So it was a pretty favorable valuation, it looks like. And then compound annual return of about 22%, pardon me. So it seems to meet the kind of minimum, it exceeds the minimum requirements that we have for the group of a minimum of 3-to-1 ratio and compounded projection of 15. So based on those strengths and the potential growth with the purchase, I kind of recommended a buy for this one. I think it's a buy with the caveat that we should probably see how the purchase of 20th 21st Century Fox goes. If they're going to go in debt that makes us uncomfortable, or even if Disney wins out and makes it maybe less of a competitive marketplace for them, or takes away too much of their market share. Maybe that's something to reconsider then, or maybe that's something will be touched on in Disney's presentation. But just based on their numbers, I think it's a buy. I think that's basically covers it. I don't know if anybody's got any questions or concerns. Or
Can you go back to the second page again, where the PEs are on the SSG? Up at the top.
Sorry. Up at the top.
Scroll up, yeah, to the first box. Keep going, yeah. I'm just wondering why it's so cheap. I know the earnings went up, so why did the price go up with the earnings considerably as well?
Yeah, I mean, I found that was interesting. They were presenting a high on their price, but yeah, it's not really moving in the way that I would imagine it would with that significant jump in the earnings.
Because Peter Lynch says price follows earnings. So when I see the earnings go up and the price doesn't, it makes me wonder why.
Yeah.
Now we're looking at a really cheap price because the price didn't go up, but the earnings did. So all of a sudden we got an average price earnings ratio, which is, so I think there's an anomaly going on. I just don't know what it is.
It was one time tax.
Sorry?
It was one time. It was the tax cut benefit.
Yeah, it seems like the Jobs Act played a role in it, and I think a lot of investors are still a little bit nervous about the purchase. I mean, a lot of the articles I was reading about it had a lot of concern about the debt. So I'm not sure if maybe that's scaring people off, or
about half the earnings came from the tax cut. It looks like.
Oh, really?
Because normally they would have had just looking at the income statement, normally they have like a $5 or $6 billion charge for taxes, and they took a $7.5 billion credit, so it's like a $13 billion swing to earnings.
Wow,
yeah,
on 22 total, so that was about half, or a little more than half. So that would make the price earnings balance out a little bit, I think.
If you eliminated 2017.
I have a question about their. I'm sorry.
Wait.
Go ahead, John.
Oh, I was just going to say, if you eliminated 2017 as an anomaly, then what do you come up with?
Well, I mean, they actually look pretty consistent at that point, or at some time somewhere between 19 and 20 and 15. I mean, it looks pretty consistent for those few years.
Yeah. Okay. Go ahead, G. Sorry.
So I want to understand about future growth. Did you maybe you have mentioned in your first cut? So what drive their future? How do they make the plan for future?
Well, so again, the plan is to really move into the streaming services and the pay-per-view kind of online streaming services, Netflix, Amazon Prime. So they're going to apparently beef up really with the Xfinity brand, and they're moving into New York and Los Angeles, big markets that they've been blocked out of. And then they're making this purchase with Sky, so they're looking to really just kind of expand the market base for them as well. And then if the purchase of 21 Fox goes through, then that's a lot of exclusive content for any business, any streaming service they really start up. So
the Sky is partly owned by the Murdoch family.
Wait, they're buying Fox 21?
Well,
they're
buying
competing
for it, yeah.
They're competing for.
Maybe
Disney
I got confused with Fox 21 with some other 21 that Disney was acquired.
Yeah, they're competing with.
So
Disney.
basically, so they are they're competing with Disney on the digital, because that's what my focus is. So they continue doing, because I felt that Comcast is playing Monopoly in the area that we live in Sacramento. If you guys agree with me, the Sacramento area folks, because Comcast is the only one we can subscribe, even though they suck. I have no choice. And so I'm guessing is I have to continue to subscribe their internet services, right? Use their internet services to streaming what I'm doing, Netflix, Amazon. I don't have cable TV. I only do is streaming.
Yeah, so do I,
correct? They do.
and I think that's exactly it. But I think they also plan on launching, or the idea is that they would also launch their own streaming platform on top of having their internet, providing you with the internet for it. They also want to provide you with the service.
Like,
kind of like a Netflix, kind of like a, oh, gotcha. Okay. Oh,
I think from
a competitor for Netflix, basically, they want to start a competitor for Netflix and Amazon Prime as part of their strategy. So they're really looking for the online market to really
competitor to be.
But I want to mention, Jay, I live in Sacramento, and there is also Dish and DirecTV. There is competition through satellites with Comcast in Sacramento. Or maybe Comcast.
Dish do.
Well, I have
Does
Dish.
Dish provide you internet service? AT&T provide you internet service. I know that, but they are not as better as the Comcast. Just about the same.
Yeah. Well, I think Dish has.
I don't know if the Dish provide you internet.
If I can, I just want to make a comment.
I'm talking about internet service. Yeah, that's.
Yeah. If I can make a comment. So I think that in terms of internet, there's probably market saturation. I don't know how much more these companies can grow just based on providing internet. So they really need to, get into the content game.
Yeah.
So Fox provides some content, but what's I think pretty significant is the acquisition of Sky in the UK. Sky has a monopoly on the Premier League soccer, and that's a huge market in the UK and around the world. It's growing at a pretty rapid clip. So if they can get that, and they can have exclusive rights to broadcast the Premier League, that would generate quite a bit of revenue. So I think, going forward, it's going to depend on whether they're successful in acquiring those assets from Fox, or if Disney is going to get them. And maybe that's why, along with the tax point that Matt raised, the price is depressed right now.
Yeah, I think people are a little bit nervous about that, definitely.
Yeah, waiting for free internet. I'm waiting for Google, because Google is working on a free internet service. Because I'm not satisfied with Comcast. Their customers.
Okay, we need to move forward.
Very lousy. We just have no choice right now.
Rails here. We need to move forward with our meeting, please.
Next.
Okay. All right. So we chose communication services and Disney. We found Comcast, but we couldn't find a close enough competitor, so we decided to challenge Disney, which is, and I just wanted to quickly show the areas that Disney is in. So they've got television, film, and then the BAMTech and Hulu. And BAMTech I'm very interested in because it has to do with the data. They do data tracking. So that's, in my mind, as far as these services go, if they can harness the data analytics, that's what's going to really push their media. So as far as Disney goes, they're really taking a strong strategy on transitioning over to the media distribution. So that's their big bid for 21st Century Fox. And as far as I know, Murdoch is really considering Disney because, and Mina, correct me if I'm wrong, but Disney is doing a stock purchase and Comcast is doing a cash purchase. Is that right?
Yep, you got it right.
All cash. And so Disney is also they've already owned some Hulu, so they would have a majority of Hulu if they get 21st Century Fox. Sky is a big, would add to their portfolio. So they are really making a big effort to try to capitalize on the transition to streaming. One of the big things, so when Tom initially did this study, he mentioned that Bob Iger was going to be retiring. And apparently, they have convinced, with the possibility of purchasing 21st Century Fox, they've convinced him to stay on through 2021. So he would oversee the deal to acquire Fox. And I just think that's all very positive for Disney. And I can't remember. Oh, it's like Incredibles 2 was a blockbuster this last weekend. They keep hitting home runs with their films. I guess Star Wars was not Solo wasn't that great, but aside from that, they've been doing great on the film side. And their resorts, let's see, their top areas are growth in China, theme parks and resorts, studio entertainment, and the video streaming, which they are very strong in, and that is counteracting the decline in their media networks and consumer products and interactive media segments. So overall, let's see, I'm going to show you the SSG on them. I don't know why it keeps doing that. Okay, so I projected 5% sales, 4% EPS. That was preferred, with the preferred method. And with all the calculations, with the average high PE being 19 and the selected low price 86.3, I'm come out as a buy. And I believe that Andrew had proposed it being a buy last month, but we ran out of time. So that's the end of my presentation. So I guess we'll move on quickly to the quarterly reports, unless there's any questions about Disney. We have.
Could you scroll down a little more on your screen?
Okay.
Just so
Do you guys with this challenge have any recommendation? Which one do you think has the best future prospect?
Well, I actually think that we could do both because, okay, even though Disney is in this area, they're a huge conglomerate. And I think they are considered under BI as entertainment. Let's see. I think if we look at, they're called media diversified, whereas Comcast is pay TV under a different sector. So we could have both, and to keep our portfolio balance.
Okay.
Joanne, I just want to clarify one thing. There are two offers for Fox, and one is cash and one is in stock.
Yes, that's what my understanding is.
Okay.
I think sorry, Roy. I think that that was initially the case, and then when Comcast came in with a cash offer, I think Disney is revising their offer, and the concern that Rupert Murdoch has is that he thinks that if Disney's offer won't have any regulatory hurdles, but Comcast might.
Yeah,
so,
I heard the other day on CNBC that the family, I think it's the son, is the one that actually runs the company now, wants stock, doesn't want the cash, but I didn't hear the explanation as to why. So that makes it sound like Disney is in the driver's seat.
Yeah, that's the sense I get.
But they still haven't made like a counter offer. They haven't raised. They haven't responded to Comcast's huge last bid.
No, I don't think so.
Yeah, so it'll be in the future.
Yeah. The other issue is, that bid is so big that, the debt is going to be a bit of an issue. I'm not sure what the profitability will be going forward if they have to service that debt.
And what I also heard is if either one of those companies don't get 21st Century Fox, there's other companies out there like CBS. I mean, not at the level as Fox, but that are potential purchases. Okay, so are we ready to move on to the quarterlies?
Yes.
Okay. Think we'll do Megumi, are you on the line? Is Megumi there? Oh.
Hello?
Hi, Megumi.
Hi.
Okay, I'm going to bring up your SSG for 5. Okay. Did you want to start and give your quarterly report?
Yeah, so Five Below is a retailer. They primarily target tweens and teens, and they offer merchandise for $5 and below, hence the name. They market their goods in themes called worlds. The themes include categories like tech, create, beauty, new and now. It's a mid-cap company, and Morningstar places it in the consumer cyclical sector and the specialty retail industry. The first storefront opened in Pennsylvania in 2002. They went public in July of 2012, and now they have 600 stores in 32 states.
Okay.
So, yeah. So with the, I can't see your full screen.
Oh, just tell me which area you want me to focus on the SSG.
Yeah, this is good. So, for the forecast on the sales, I selected 18% based on the 2-year analyst forecast is 19.8. The value line had 18, so I just picked the more conservative of the two. And then for earnings per share, the analyst figures are 26.2, and the preferred was 13.7. And I have to say, I just guessed and put something in between. And next page. So for the price earning history, I deleted the 2013 figures because they're both high, seemed high to me. And then for the next judgment, I believe is the average high PE forecast. And somewhere there was a note that said that 30 should be the max, or 1.5 times the growth rate. So I selected 30, which gave me a high stock price forecast of 145.8. And then for the low, what was the low? So the low of 26.7 was that 5-year average low PE from the SSG. Does that sound right? Okay. And with all those numbers, it places the stock in a hold position. And so with the low, I think with the low, I tried all the different scenarios, and it didn't do anything to the end result.
How much is the price up recently?
The closing price was $100. I don't know.
Didn't it go way
today.
up?
It's like up 50% in the last 2.5 months.
Yeah.
Yes. So I'm just wondering, the current PE is 38, and you are projecting the average high of 30. Now, do you think that's realistic?
You know, I honestly, I don't know. There was just, I based that on a guideline that I read on a sheet in one of our folders. that it should be 30, that the average high PE should be 30 max or 1.5 times the growth rate. So
I think that's Roy's rule too, isn't it?
Well, it would be designed. If we could
It's
design
not
that, that would be good. But
It's not that you pick 30, it's you don't go beyond 30. So if, now here the numbers are high. So I think, because some people would say, oh, with those numbers, I want to pull 38 or 40. So I think 30 probably makes sense. But I didn't see the first page. What's your projection for growth?
growth projection was 18.
18 and 18. So 1.5, that would be 27, not 30.
Wait, say that again? Oh, 1.5 times the growth rate. Oh, it would be 27.
Actually, wait a minute. 18.5, so 27, 28, something like that.
Rounds up to 30.
I also don't use decimal points. As Ken Kavula would say, we draw these with crayons, not sharp pencils.
Okay.
Okay, so your recommendation is for hold?
Sure.
Okay.
Yeah.
Roy, would you like to give your report on HICO?
Okay.
I have a question. Sorry, can I ask a question? Sorry, I did not review things on time.
Well,
McKinney, I
you
just
don't
looking,
review it,
I'm
you
more
can't
interested
discuss
in
it.
the,
I'm just kidding, but I
I'm
really
sorry?
want people to discuss before the meeting.
Oh, I did not hear. It's just someone break up. Sorry, for your report, are there any positive and negative news or anything come up from the first quarter earnings? Because you did not complete your report. I'm just curious.
Everything indicates that they're growing a lot. I mean, the forecast is that they're gonna, they want to reach 2,500 stores. What was it in the next year? Let's see.
I think it's like in three. That's what
They plan to open 125 to 150 new stores in 2018.
That's why the
advantage
stock,
of economies of scale.
the stock popped a lot because of that.
What was that?
Okay.
So the stock price went up
So,
quite a bit
okay.
when they announced the store growth.
okay, I have
Okay.
one
I can't
question.
hear you.
If the upside downside ratio is 1-to-1, that means there's an equal
Right.
chance that we'll go up or down. Do we really want to hold a stock that's 50-50 chance? Can't we find better options?
Yeah, no, well, I think her growth numbers are a little bit conservative, and I don't know. I think it's going to quadruple its stores. That's pretty impressive.
Well, okay, then the SSG is wrong.
No, it's
Yeah,
not
we
wrong.
made a pretty good profit.
It just doesn't take into account they're going to quadruple their stores.
So, John, when you say the growth numbers are wrong, you're talking about these numbers on the front, the sales?
I just said that I didn't say they're wrong. I said they're a little bit conservative.
So you think that it should be higher than 18?
Well, I used higher numbers when I bought the stock 50% ago, and I think that when a stock does really well, I don't like to sell it unless the fundamentals look bad, not just the price, but the fundamentals. And their fundamentals look really good at this point to me. So I used, let me see, the numbers I used were, and there's nothing wrong with those numbers. It's just I used 22.7 and 25.3.
Should we try that?
Sure.
Yeah.
Oops. What was it?
It was a much better buy 50% ago, 2 months ago, 3 months ago.
John, what was that? What were the numbers?
It was 22.7 was the sales, and 25.3 was earnings. 25.3.
So how did you get those numbers?
I can't be honest with you. I figured them out a month ago or 2 months ago, so I don't. They came from the usual places, earnings estimates. But I think the optimism, because that's what made the stock really go up. I mean, it went up just incredibly, like 26% in one day, because they came out with the store growth. And it's pretty hard, to exactly predict. But my guess is that was a new number because a 26%, I've never had a 26% jump in one day on a stock. So I kind of noticed it.
So even with those growth numbers, it doesn't change it out of a hold.
Right, a hold's good. I don't think it's a buy. I don't think it's a buy at all right now. I think it's expensive, but expensive stocks usually can do well for a very long time.
But instead of a 1-to-1, it's now a 2-to-1. So
yeah, and even if it's 1-to-1, I don't know. I try to be I try to almost never sell a good company, even when it gets expensive.
So I guess I don't understand why the news is good, forecast is good, but it's still a hold. What's causing it to be a hold?
For one thing, the PE we chose, we have the limit of 30, is way below what it's been doing. So what it is, it's been overpriced. But we're using very conservative projections. That's why. If we use the higher prices, it would be in the buy zone. I mean, the higher PEs.
I'm not sure it'd be in the buy zone, but it'd at least be in the better hold zone.
Well, if you kicked it up to like a 40 for the average high PE, I'm sure it would get into the.
I think also the earnings estimates were before the
kicked up to a 3.5, but that's being very, very optimistic. And I agree. I mean, I think 5 should be doing quite well with the growth, but. Do we want to bet on that or use the more conservative SSG procedures? And I kind of lean towards that latter.
Well, I got an average.
It's a solid hold, but I'm not sure about putting more money into it. But
no, I think there's too much risk right now. But then again, when stocks do well, I usually try not to sell them unless there's a fundamental difference, like they're not going to make any more stores or the stores aren't doing well. So
no, I agree with you.
Yeah. I got an average PE of 32.5, a high of 43.6, and a low of 26.7. So right now, a PE of 48.1, exactly the same. So I think it's just a good hold.
Okay. Hold. Can we move on to the HICO? Or do you still want to talk about it? I am not timing this, so you guys can have it as long as you want.
You can send it to me. I'm not sure, the discussion, but go ahead.
Okay.
Shoot me the screen.
Give you the screen?
Yeah.
All right.
Okay, you guys see HICO, SSG? Since this is a quarterly report, not an annual, I did not update the SSG itself. I did update the data. But as you can see, last quarter, oh, by the way, the agenda says quarter 1. We're looking at quarter 2. The earnings jumped to 29%. And as I put in the evaluation, that was primarily due to both the increase in defense spending, but also that they had acquired 5 companies, 2 of them in the last 3 months. So that booted their revenue and earnings up. And you can see, and I lied, I do have a decimal point in there. Normally I would just round that up to 19. But the quarter exceeded the earnings and just about met the revenue. Now I have on the evaluation that the sales grew 16.8. Let's see. Yeah, so I don't know why on the first page this shows, oh, that's the estimate of 11. Yeah, there it is. Sorry. So anyway, the quarter outperformed our expectations. The troubling part is the price, has gone up. Using my top of a 30, we come to an upside down ratio of 0.9 to 1, and the growth rate of basically 5%. So it's a hold, although it certainly with Tom's comment, it would be in line for a sale. But I think for the next quarter at least, these new acquisitions and the increase in defense spending, they should hold these numbers and continue to do well. I probably wouldn't buy it. I mean, if I were to try to fudge numbers, because I think the 5-year won't hold up, but it certainly, I think, will for the next quarter. But I'm recommending a hold, but I'm open to other suggestions. And that's it. This is a quarter, so it's short and sweet.
Well, the average PE is like almost half of the current PE. So yeah.
Yep. Yeah,
Okay.
it's a little rich.
But when you own a stock, you like to see high PEs, right?
Yeah, I'm certainly not recommending buying anymore.
No,
at
but
this
just
point.
yeah, good.
But it should. I think for the next quarter we'll continue to do well. But I'm not
Do you
in
think the
Las
tariffs
Vegas.
will start to hurt them?
I'm sorry.
Do you think the tariffs will start to hurt at all?
I don't think that they import much. I think they manufacture most of the products they sell, and they sell primarily here in the United States. They do have a European outlet. So if the EU were to jack up the tariffs, that could hurt. But the thing is, they're so specialized, the airplanes that need their services. So they're almost bulletproof in that respect. It would take other companies quite a while to tool up to replace them.
Yeah, it might help. I don't know, with all the defense spending in it.
So yeah. Besides, I'm crossing my fingers that it's just a lot of bluster.
Okay, so can
Cross-armed.
we move on?
Yep.
Okay, Hanny was going to present Tencent, but there are issues, and he's going to discuss those. Hanny?
Okay, thank you,
Oh,
Joanne.
Do I need to do something to send it back to you, or can you grab it?
Oh, I'll grab it.
Okay, thank you.
I'm not going to show anything. So I just, my only comment on Tencent is when I started looking at financial data, there was very little except for what the company is putting on its website. And so, you know, there are no SEC filings. It's mostly just their reports, and they tend to be a little bit late. And so it's going to be difficult analyzing this company, you know, based on that. It's not difficult. It'll just be maybe not the same level of comfort that we would have if they were, you know, reporting through a government agency where there's some penalties for misfiling and so on, and misrepresenting. So that's all really that I had to say. I just wanted to get comments on that. It seems to be doing well. It's you know, it's growing at a pretty fast clip. and I think there's, from everything that I read, there's a pretty good growth runway, but if the lack of detailed financials worries people, then we might want to look somewhere else. But I'm happy to continue to monitor it.
Well, in your opinion, is it? I mean, that the state of the financials, does that make it? How risky does that make it?
Well, it's not just risky. It's the way that they report. It'll take a little bit of maybe gymnastics to try to get it into numbers that we're familiar with. I'm not a finance person, so it might, I'm limited in that regard. Maybe someone like Jane might have a better view on this, but in terms of risk, I think, I can't remember who said it. Was it Tom or Roy? I mean, you had Enron, and that was a publicly traded company reporting it, through the SEC, and we all know what happened there. So it's just the financials are a little bit might be difficult to get them in the form that we require.
Okay. Thank you, Annie.
Okay. Any comments, suggestions? Should we continue monitoring it?
Or does anybody have objections to holding this
Yeah,
stock?
I think so. Do you think we should sell it as being too risky, or we should just hold it and see what happens?
Hold it and learn.
Yeah, I would hold it and see what happens.
That sounds good.
Yeah.
Okay, so now we're to the discussion and voting part of our meeting.
Can we have the treasurer's report before we vote?
Oh, okay. Well, okay.
Because the reason is that
Also, can I make?
Sorry, go ahead, Jay.
Sorry, based on your meeting agenda, is next month. Ozark is due. Ozark is not due next month. Actually, it's August. Ozark is same month as the many other stocks are doing in August. I don't know why it says next month. Check the calendar again based on the historical data. It is August.
Okay, fine.
Okay.
The only reason I suggest that we have the treasurer's report is once you see some numbers, you may want to that might come into your decisions to buy, sell, and so on. So that's the only reason.
Well, the only
That's a good idea.
The only ones that should be for consideration are the ones that are discussed. Are you thinking that it's going to change that?
Possibly.
Okay.
Well, why don't you quickly go into it?
Okay. Joanne, do you mind?
Sure.
Yeah, please.
Okay, hold on a second.
Doesn't Bank of the Ozarks report March, June, every 3 months? I remember December was the end of the year for their annual report, not January.
Not sure. Can everyone see my screen?
Yes.
Yeah.
Okay. So I'll start out with the punchline. So underperforming stocks based on the gain loss report are MID, Ozark, and PSA. Deteriorating metrics from the trend report, and you'll see all of these in a second, are MID and PSA. The REITs, and then the bottom five, PAR, which is the projected annual return, and that's a manifest investing term where they project what the return will be going forward. So I'm tracking our portfolio on manifest investing. dashboard, and you all have access to that link. If you don't, I can send it to you. But the bottom 5 stocks are HEICO, Disney 5, O, and PSA. Now, O and PSA are REITs, and because of the rising interest rate environment, REITs tend to underperform, both because of interest rates are going up, so people can shift to those, but also because REITs are typically have a lot of debt that has to be serviced in a rising rate environment. So that's probably the reason for those two, but they do pay a dividend. I just wanted to show you how the portfolio is doing versus various benchmarks. And I found this interesting comment. It's on the internet somewhere. It says a lot of people decided since they can't beat the market, they might as well be the market, and that's basically buying ETFs or index funds. So how is our portfolio doing against those? So lifetime to date, and we started the club, or the group that started the club started in 2016. So to date, it's 26, roughly, say 27%. The Vanguard S&P 500 index fund in that same time period has done 15%, so we beat it by 11. The iShares IJR, which is a small cap S&P, has done 0.43% since that time, beat it by 26%. And the Russell 2000 index IWM, and by the way, just for transparency, I own both IJR and IWM. But we beat that by 6%. And if you look at the 1 year compound annual return, again, we beat all of those 3 indices. So we're doing quite well. This is what's called a gain-loss report, and that's off of iClub, and our portfolio is monitored there. Basically, it shows you the how much money we've made on each stock since it was purchased, and I couldn't sort these, unfortunately. It only provides it in a certain format, but you could see we've lost money on Middleby, Realty Income, Bank of the Ozark, Public Storage, and then Tencent we just bought. So it's I wouldn't take that into consideration. IPG is our best performer, and Facebook. We have 3 purchases of Facebook, and that's done quite well at 117%, IPG 181% return. So pretty decent return. The average gain loss, or sorry, not the average, but the overall gain loss is about 32% since inception. This is the trend report, which I mentioned, and this is basically from similar to Toolkit. It looks at the trailing 12-month EPS and quarterly EPS, pre-tax profit. So the current versus the past quarter, and the ones in red are ones that are deteriorating. So again, Realty is actually doing better, 7.4 under the quarterly EPS. The most recent is 7.4. Before that, it was negative 36. So they've improved their performance. But if you look at in terms of trailing 12-month performance, the worst one here is PSA. So it's gone to negative 3.8 from negative 1. The rest are all they're negative, but they're kind of improving. So we may want to look at those. And this is the manifest investing dashboard, and the thing to look at here, or the reason I put this up, is you can look at the PAR, which is the projected annual returns. So Tencent, they're projecting a 34 or 35% return over the next time frame. It's kind of vague. I think it's 3 to 5 years. But the quality is only 64. Facebook, on the other hand, has got very high quality at 92 and projecting 16%. So all of these, Bank of the Ozarks quality is deteriorated at 62%, but projecting a return of 12%. So if you look at the bottom ones here, these are kind of problematic, or what these are the ones that are not going to perform maybe as well. The bottom 5 here are PSA, Realty, 5, and Disney. Is that 5? And then Heiko, I guess those are the bottom 5. So if we were trying to beat the market or get a certain return, we may want to consider doing something about those ones if we don't believe that they'll keep up with the top half of this table. And I think that's okay. This is the last slide, which is just diversification. You've seen this before. We have about 60% smaller companies, 16% large, and 23% medium, which is not a bad split. We are heavily weighted on technology and financials, but other than that, we're pretty well diversified. So not bad. Questions? Yeah.
That's probably why we're doing so well.
Yes.
A lot of smaller stocks and technology and financials.
So the other day, go ahead.
Sorry, go ahead, Bernard.
The other day in Barron's, they're projecting an 18% growth in Bank of the Ozarks. 18% in the next year, that the earnings should be up 18%. And so, well, anyhow, that doesn't kind of jive with your figure, Haney, but I just want to mention it. I don't know what's right.
Well, it might be that sounds kind of recent. I'm not sure. I know that Manifest goes out and they look at a number of different sort of sources. So I'm not, and that's a total return. So if they're projecting earnings to grow by that much, I'm not sure what the sales are. So it's hard to tell. It's hard to gauge. But I mean, I think the main issue here that these are just sort of things that would cause us to ask some questions and maybe dig a little bit deeper. It's not a trigger to go and maybe sell something or whatever, but just examine it in a bit more detail.
Haney, how much cash do we have? I didn't notice that.
Sorry, I thought I had a valuation on here. I didn't put it on. We have about $3,600.
Okay, so we could buy at least 3 stocks. But like Joanne said, we really should only be buying something that we've looked at. There may be other stocks that would be a buy, but if we don't have up-to-date information today, then I would certainly pass on those. So I'm ready to make a motion once we reach that point.
I think somebody else had a question. Was it Jane?
Yeah. Can I see the first slide with the annualized return?
This one?
Yeah. And you have this 26% over about 2 years' time, and you have 28% annually?
That's just 1 year.
Yeah, annually 28%, but 26 over 22 years time, 26%, 0.64.
Yes.
That's over 2 years, so it's annually.
Yes, that's for the entire period.
For the entire period is 26%.
Yes.
But the annual is 28%.
The annual is just for 1 year. So it's very specific for the period ending December 31st. So it's just a slice in time. So it's but I understand what you're getting at. But one is
yeah. Does it include a realized profit?
Do you mean the dividends or?
No, realized profit. That some profit you have realized on the sale of the shares?
I'd have to check. Yes, I think it does. but I have to check that. I'm not certain.
Okay, thank you.
This is
That 26%. Did you get that from Morningstar's?
No, this is from iClub. So you know, as you know, Roy, we put all the.
They are the ones that calculated that. And is this actually a per year? You know, on average, it's a 2-year period, but is it annualized?
I think that's the return from the start to 17th of June.
Okay. So that what that shows then is some of the current purchases are down. That's why the lifetime to date is less than the 1 year.
Yes.
Okay.
And if you look at the you know, there's a couple of stocks in here that have done very well, and I think those are, you know, and those are making up for the rest. So certainly, like, we've done very, very well with IPG and Facebook and HEICO. So those are, I think, masking some of the others, and that's why I guess my point.
Now this
in all
was like 32, not 26%.
Yeah, so I think that's this one is though from a different time period, and it's a bit confusing because I don't know exactly when they take those time periods. So this one is just this is you know, that's exactly how much we made based on how much those have gone up, as opposed to taking it over a specific time period.
I think 26 is the annualized return, and then that includes realized profit. But the 32 is the unrealized profit as of now.
That's the actual, yes.
Okay, thank you, Haney.
You're welcome.
Okay, Joanne, should we move to motions?
Yes. Yes.
I'd like to make two. I probably, you know, I would make the one motion to buy two, but I guess we need to make them separately. I make a motion that we buy $1,000 of Comcast.
I second it.
What's your other motion?
The other one is to buy more Disney.
I second that.
Okay.
Just for my sake, how much are you recommending? 1,000 of Disney as well?
Yes. That's what our charter is for.
Okay.
Okay. I seconded the Comcast. So everybody vote.
Well, first, any discussion?
Comcast first.
Discussion, yes.
So I just wonder, because just now we have the stock study on Disney, and it seems to be a good buy. But then according to Haney's analysis, or a brief analysis, it seemed to be something is not doing well.
No, it's not that it's not doing well. It's that the return, his projected return wasn't going to be high enough.
Okay.
Because I think
that's also to the size of the company.
I think the quality score is 91. It's a high quality company.
Yeah,
we have no doubt it's a high quality company, but in terms of current valuation, is this something we want to buy in now? I mean, it's a big company.
Yeah, how do you balance the quality versus the other column? I mean, how do you?
So I think because it's a very large company, in order for it to grow by 10% or something is going to take quite a bit of of sales.
Okay.
So usually the larger companies don't grow that much, but Google is an exception. Now if they make this if they are successful in this Fox deal,
Mhm.
and given where the stock price is right now, it potentially could go up quite a bit. And the same for Comcast, depending on who ends up winning that competition.
I see. But I'm with you,
That's
Jay.
good
I
news
hate
to buy both
Comcast
of them.
too.
Yeah.
Okay, are we ready to vote now?
Okay.
So is the first one Disney or Comcast? Which one are we voting on? Comcast. Once we vote, send another email, or does it automatically refresh?
Shoot, I don't know how to clear it, but we'll see. I have to clear the ballot and then.
Okay.
I didn't get an email.
Yeah. Hold on. Let me go clear. You just go to. Are you casting?
Yeah.
Are you?
Megumi, you should have
Are you
gotten an
casting and
email
join?
that said.
Okay.
Am I waiting for an email?
So you click.
You should have gotten an email.
The response. Let me see your screen.
I don't see one.
Yeah, it's already in your email. Why cannot see your screen? Oh, that is your screen. So yeah, can you click that join?
What?
Maybe there's a.
What do you want me to do?
Oh, I'm not looking at my own screen. Oh, is this your screen? I got confused because there's the latency, it's a delay. So you open up the stock, the main one, and then under response, click the response.
Does it have to be secret? Can we just verbally vote?
Yeah, that might be a good option.
It'd be faster.
Yeah, I think.
I
think verbal is fine, unless somebody's not comfortable.
Okay. And then did you see that the setting gear and join? Oh, sorry, not setting gear. Right now, next to a picture, there's 3 dots. Did you see that?
Do you see what? Jay,
I'm talking to Joanne.
I can't hear you.
Do you see the 3 dots next to your picture?
Yeah. Okay. What do you want me to do?
You cannot hear me?
Yeah.
What about now?
I can hear you.
So did you see the 3 dots next to your picture? And then click that.
Oh wait, first we have to see what the
so click that dot, and then did you see the delete?
No, wait. These are the results for Disney.
Wait, maybe something.
Comcast.
Oh, Comcast. Sorry, Comcast. 87.5 to 12.5. And we didn't get votes from Megumi, Tom.
But the problem,
Andrew's absent.
I still don't have an email.
Oh yeah.
Well,
I don't know. But that's fine. I don't. That I would vote for.
You looking for stock? What do you call it? What did you call it?
So
Jay.
I voted for
it's called
Comcast.
Stock voting ballot.
She sent it.
Jay. I think it's easier if we just vote verbally.
Okay.
Yeah.
All right.
Yes.
I vote for Comcast.
Okay.
I do not vote.
Okay.
Disney.
I'll just do a roll call.
Yes.
Okay. Mina.
Yep.
Okay. Hanny.
Yes.
Jay. Okay. Jay. Matt.
You already have the 8. Why don't you just do a roll
Yeah.
call of the 5?
I can't
vote?
tell. I can only see
it's on the.
who sent it in.
Yes.
Okay. Go
Okay.
with. I'll do it. Andrew.
He's not here.
Okay. Barry.
Not here.
Yes. Yeah. My internet.
Bernard said yes. Ron. Tom.
I say yes for Comcast. Yes for Comcast.
So and then Megumi.
It passed.
Yeah. Yes.
So
Okay.
that makes it. Can you go move the thing again?
It's like
Go
8
this.
to 1, 9 to 1.
So 7 to be 10 to 1.
10 to 1. Okay, passed.
Okay.
We do the next one verbally?
Okay.
I think maybe next month we might try using the voting machine in iClub Central.
Okay.
You already.
Do
Okay,
we
so-
have discussion for Disney?
I think Iger said he favors Disney. I think Disney's a stable company otherwise, and I think it's a good idea to take a chance on it winning the contest.
Even though the return is going to be projected to be low?
Well, I don't think you can project what's going to happen once they get that content. So I think it's very difficult to know, but at least it's a stable company. It's not going to go in the trash can.
Okay.
Yeah. My personal feeling is I would tend to vote against it because if they're retaining Iger, that's because I don't like him. But I think he probably is a stabilizing force for the merger. So
I think
I'm
it's hard.
voting yes.
I don't know if we gain a lot, but I think it's hard to lose. So it's good upside downside. Is my
So,
feeling.
Roy, what are your objections to Iger?
I think he's a total jerk, but that's not a very financially.
Amen.
Yeah, but
Amen.
that's not a business.
Oh, and it's a business decision. It's just not a financial one.
Right.
But then I feel the same way about Facebook. So.
Okay.
I won't tell you how I feel about Trump.
Okay.
If he owns a company up here, it's ripe for that.
I think Iger should run for president, right? Go ahead.
He shouldn't come to Canada is the point.
Yeah.
Right.
Okay, so
You
should we
shouldn't
vote?
come here either.
Mina?
Yep.
Okay.
I say let's buy it. Why not? We have a lot of cash on hand.
Okay, Hanny?
Yes.
Jay? Matt?
Yes.
Okay. Matt?
Yes.
Clothesline. That's John.
That's
John.
Yes. Yes.
Jane?
Jane, no.
No. Roy?
Yes.
Okay. Joanne, yes. Megumi?
Sure.
Tom? Bernard?
No,
He left.
Okay.
not on Disney. No on Disney.
Okay. So I've got it's 8-2 Disney. So Hanny will purchase 1,000 shares of Disney and 1,000 shares of Comcast.
Yes.
Okay.
I'll
All
do
right.
that tomorrow.
Yay.
If anybody wants to stay on, I will
want.
show them how to do the. Okay, I'm ending the meeting. We've gone over.
Hold on.
48 minutes. I just want to tell you guys, I don't want to be the person that monitors the time because you are all going over. So we're going to have to decide that we want to make a longer meeting.
Yes.
Okay. All right. So I'm stopping.
I also want to make a motion to put out PSA.
Hello, I'm stopping recording the meeting, and we'll take comments from the guests, and then we'll have.
I guess you guys did not see my note.
No, we didn't see anything. Okay, I'm